For the past 12 months, SCHD has been basically flat, and that is pissing investors off. If you are one of these people and you are wondering whether you should hold on to your shares or get rid of them, stick around for this video. You see, in 2022, the markets collapsed. Everyone was worried. The S&P 500 was down 20%. The Nasdaq 100 was down 33%. Even bonds got killed with double-digit percentages. And yet, when you opened YouTube or any investment-related group, there was one ETF that dominated the discussion: SCHD. You can even see this behavior was picked up by Google Trends, the service provided by Google that shows how certain topics were trending. And of course, amidst all the carnage, people wanted a safe place to invest, somewhere to hide from the storm. An investment that was full of large, stable, non-volatile cash cow companies that kept paying dividends throughout the years. Well, what would that place be? You guessed it, the Schwab U.S. Dividend Equity ETF, full of large dividend-paying companies like Coca-Cola, Chevron, Home Depot, AbbVie, and many others. The ETF fell only 6.5% during the market bloodbath I described. At the same time, its dividend yield has averaged between 3 and 4% for the past couple of years. Most impressively though, the dividend growth rate for the past decade is over 11%. And so, naturally, during the 2022 market downturn, people ran towards safer, cash-flowing investments full of big, well-established, mature, dividend-paying companies. Now, I have an entire almost 40-minute video on SCHD, which at the time of recording this is probably the most comprehensive review of the ETF you can find on YouTube. So I won't get into the details of the fund and how it is constructed here. When the current video ends, you will be able to click on it and you will be redirected there, so don't worry about it for now. What is important to know is that SCHD follows an index of companies that are screened for paying dividends in the past 10 years and also for fundamental strength related to their debt profile, efficiency in using their capital, and growing their dividends for the past 5 years. As a result, you can see what types of companies currently make it in the ETF. So, naturally, during the downturn, the ETF held pretty well because of its focus on well-established, fundamentally strong value companies. That led to an absolute flooding of the investing social media landscape in the past 2 years, with people talking about SCHD. Some YouTubers even tried to create a whole channel out of it. Jesus, 12 out of 12 consecutive videos. Come on guys, you can do better than that. Naturally, a lot of investors, some of them allured by the widespread popularity of SCHD, decided to invest in the ETF. And then, 2023 happened. AI gripped the public's attention, liquidity conditions improved, and the major indexes skyrocketed. S&P 500 was up almost 25%. The Nasdaq 100 was up over 50%. And basically, the majority of other indices, which all have the same companies in their top 10, went up with double-digit percentages. Even something like Vanguard Total World Stock Index ETF was up almost 20%. However, what did our hero of 2022 SCHD do? Basically, nothing. As a result, the people who invested in SCHD with conviction, or so they thought, in 2022, started getting angry and thinking about replacing the fund with something else, or even feeling like they got played chasing dividends. Now, while I'm empathetic to them, let's pick that thesis apart. What do all the funds I just mentioned that had a great year in 2023 have in common? Let's check their top 10 companies. Here they are for the S&P 500. Here they are for the Nasdaq 100, also known as QQQ. And here they are for the Vanguard Total World Index. I'm putting Total World in quotes here. Hope you're noticing a pattern. Basically, whichever of the major indices you grab, they all have the same companies in the top 10. And these companies also became known as the Magnificent Seven. Which are they? Apple, Microsoft, Amazon, Nvidia, Alphabet, the parent company of Google, Meta, and Tesla. I will not get into the details of why these companies exploded in 2023, but there are a few reasons, like investors wanting to front-run the AI opportunity, improving liquidity profile, and others. Here is an example of the return these companies had in 2023. Apple, 48%, Microsoft, 56%, Nvidia, 238%, and the rest of them are pretty much like that, with the exception of Nvidia, which was just a monster. Now, Which are the top 10 companies in SCHD? Not a single one of the magnificent 7 stocks are in there. And this is completely normal and to be expected. SCHD is built to have stable, dividend-paying companies with moderately high yields. So, of course, it won't include a company like Nvidia that has something like 0.03% yield, or Amazon that doesn't even pay a dividend. The next reason for SCHD underperformance is the fact that for the first time in a very long period, dividend payers actually have competition from credit investment instruments like bonds and money market funds. The reason for that is the fact that Fed and other central banks all around the world raised interest rates, which of course means that you can get higher interest on your cash. The 10-year Treasury yield reached almost 5% in 2023. Since this is used as a benchmark for a lot of other products, people could get 5% on their cash in a money market fund. For a lot of investors, that's enough to dissuade them from putting their money into a 3.5 yielding SCHD. As a result, dividend stocks and funds in general experienced outflows through no fault of their own. This doesn't mean that the quality of the underlying assets got worse. It is just that comparatively they weren't so attractive. And there is also a third reason for the underperformance, which is relatively insignificant, but it's worth mentioning, is the fact that one of the top companies in SCHD in 2023, Pfizer, got destroyed. Pfizer occupied a top position in SCHD in 2023, so this had a small but nonetheless worthy of mentioning effect on the ETF. In my opinion, this was undeserved as Pfizer's earnings simply went down because of the reduction in COVID cases. However, their non-COVID products are actually experiencing upper single-digit growth. So this is like having a 10K a month salary, receiving a 100K bonus in April, and then everyone thinks that because in May you are back to 10K a month, you are somehow worse off. It doesn't make a lot of sense, but this had some effect on SCHD. Speaking of the decline of Pfizer in 2023, if you would like to see which are my favorite 4 stocks and ETFs for the current economic and geopolitical environment we are in, go to the description below and get my free report. The report will be sent instantly to your email address and will be up to date regardless of when you are watching this because I'm constantly updating it. Okay, so now you understand the reason why SCHD outperformed the so-called broader market in 2022, even though it is anything but broader, and underperformed it in 2023. Let's get to the most important part of the video. Asking yourself the right questions. The first question is, why did you invest in SCHD in the first place? As I teach in my channel and also the students in my educational program, the Dividend Method, it is vital for you to understand the reason why you are investing in any type of asset. Because if you don't, then what happens is exactly the issue with a lot of SCHD investors. Did you invest in SCHD in order to beat the S&P 500 or the Nasdaq? Well, in that case, while in some years that might happen, you have the whole investment thesis wrong because SCHD has not been created with such a goal in mind. The goal of the ETF is to provide stable and predictable passive income from mature companies that are no longer in their growth phase with a lot lower volatility. And in that regard, it is doing quite well. If you notice the classification of the fund, it is regarded as value, unlike the Nasdaq 100, for example, which is categorized as growth. And if you purchased SCHD for a stable dividend with good dividend growth, then why would you think of selling it now? What has fundamentally changed in the investment thesis? And no, 1 year of weaker dividend growth does not count. As I mentioned already, the concept of investment thesis is extremely important. I have a guiding principle. If the investment thesis hasn't broken, I don't sell, regardless of the short-term result. Of course, I might do it if I see a better risk-adjusted opportunity for my capital, but never to chase better performing stocks or funds. I never go into a stock or an ETF with the idea of selling it. I'm always there for the long term. Doesn't mean I won't sell it, but it's just the mindset I purchased the investment with. Another question you have to ask yourself is, what type of an investor are you? If you love a fund because it beats the S&P 500 1 year and you hate it because it underperforms it the next year, I regret to tell you that you won't get very far. This type of behavior will make your portfolio feel like a roller coaster ride. You will be constantly overtrading, overworrying, and undersleeping. Undersleeping? Is there such a word? You will get in and out of positions, try to time the market, and will probably do more harm to your portfolio than good. Speaking of timing the market, as I already mentioned, because of the rise in interest rates, a lot of people decided to stay on the sidelines and get 5% on their cash. While I have nothing against that, this also carries a lot of hidden dangers for your portfolio. There are very few professionals who can accurately predict when rates will go down or up and what happens with the stock market. Ultimately, the decision is made by a handful of people in the central banks, and none of us can do anything about it or predict it. As a result, you might be sitting comfortably in a money market fund with 5% yield, waiting for the storm to pass. And by the time you think it has passed, half of the rally in stocks might have already happened, leaving you behind in the dust. A good example of that is 2023. People sold off their big index fund positions to move their cash to money market funds, expecting a recession or further continuation of the bear market, only to finish 2023 having missed the 25% rally in the S&P 500 and the 50% rally in the Nasdaq 100. The lesson is, if you think you can time the market and move nimbly in and out of positions, you probably cannot, and you will be doing more harm to yourself than good. So, it is best to pick fundamentally good companies and ETFs, understand the reasons you're investing, get educated, and stay the course until something changes. If you want help with that, I invite you to join my free investing masterclass, where I compare different styles of investing, talk about dividend investments, and also answer investment-related questions of the audience. You can scroll down, find the link for it in the description, open it in a new tab, get back here, and sign up for it after the video ends. I will wait, no problem. So let me know in the comments, did you have any regrets holding SCHD in 2023, and what actions did you take? Also, as I said earlier in the video, check out my complete guide I did on SCHD that should have appeared on your screen already. There, I do a comprehensive research of the ETF and I analyze every single of the filters applied that basically create the fund and its holdings. The feedback for the video has been amazing, so if you are interested in SCHD, I'm pretty sure you will like it. Thank you for watching, and I'll see you there.